One of the most important principles of financial literacy is this: money should work for you. Most people spend their lives working for money, trading labor for paychecks to cover bills. It's a never-ending cycle. But what if your money could work alongside you? Imagine every dollar becoming a tireless employee, bringing in results year after year. That's the true power of investing, turning your money into a team that works for you 24/7. Let's start with a simple example. Imagine you have $100 in an investment that earns 7% per year. In the first year, you make $7. That might not sound like much. But here's the secret: compound growth. In the second year, you earn on your original $100 and on the $7 profit. Your base becomes $107, growing to $114.49 at 7%. The next year, it grows again to $122.89. Over time, the growth accelerates. It's like rolling a snowball down a hill, small at first, but gathering snow, it grows faster and faster. This is why Albert Einstein reportedly called compound interest the eighth wonder of the world. Now, compare this to simply saving money. If you leave $100 in a savings account with 1% interest, after 10 years you'll have about $110. That's barely noticeable. But if you invest at an average of 7% annually, after 10 years you'll have almost $200. That's nearly double, simply by letting your money work. This isn't just about numbers. It's about real-life opportunities. Imagine two friends, Anna and Ben. Anna starts investing $100 every month at age 20. Ben waits until age 35 and then invests $200 a month, trying to catch up. Who ends up with more money by retirement? Surprisingly, it's Anna. Her extra 15 years of compounding gave her a massive advantage, despite contributing less total money. Time is the most powerful multiplier when it comes to wealth. Here's another way to think about it. Every dollar has two possible futures. Future one, you spend it on something temporary, like a coffee or a subscription you barely use. Future two, you invest it and it grows into $10, $20, or even $50 over time. Which future would you rather choose? But maybe you're thinking, I don't have enough money to invest. That's one of the biggest myths. The truth is, you don't need to be rich to start investing. Even small amounts can make a big difference over the long run. If you invest just $20 a week, about the cost of 2 movie tickets or 3 lattes, at 7% growth, in 30 years you'd have over $100,000. That's the power of consistency combined with compounding. Another common worry is, isn't investing too risky? The answer is, it depends. Yes, some investments are risky if you chase quick profits or gamble on trends. But there are also safer, long-term strategies like index funds, bonds, or diversified portfolios designed to grow steadily over time. The key is not to avoid investing, but to understand your comfort with risk and choose wisely. Remember, doing nothing with your money also has a hidden risk: inflation. If your money just sits in a savings account earning 1%, while prices rise at 3% each year, you're actually losing purchasing power. Investing isn't just about growing wealth, it's also about protecting it. Let's visualize this another way. Imagine you planted 2 trees at the same time. One tree is watered with 1% growth. The other is watered with 7% growth. At first, they look almost the same. But after 10, 20, 30 years, the second tree towers over the first. That's what compounding does. It multiplies the difference over time. This principle, that money should work, doesn't mean you have to be a financial genius, predict the stock market, or take extreme risks. It simply means you understand that money, when placed in the right environment, can generate more money. It's a shift in mindset, from being a worker to a builder who creates a system where money and effort work together. So let's recap. Money can be turned into your employee. Compound growth makes small beginnings turn into big results. The earlier you start, the greater the effect. Even small amounts, invested consistently, can become significant wealth. Avoiding investing has its own hidden cost. Inflation eats away at your savings. Here's the question you should ask yourself. Are your dollars just sitting idle, or are they out there working for you? The sooner you put them to work, the sooner you'll have a team of little employees building your future. And remember this, every paycheck you receive isn't just money to spend, it's potential energy. You can choose to burn it quickly, or you can plant it so it keeps growing. The decision you make today could mean the difference between financial stress and financial freedom tomorrow. Welcome to Investing, where we'll break down what it is and why it's not just for the rich. It's a tool for anyone to build a better financial future and achieve long-term goals. Let's start with a simple question. What's the difference between saving and investing? They may look similar. Both involve setting money aside, but their fundamental difference is huge. Saving means placing money in a safe place, like a bank account, earning small interest, suitable for short-term goals. It's like storing water in a tank. Your money is protected but doesn't grow significantly. Often, it grows slower than the cost of living, meaning its purchasing power diminishes over time. Investing, however, is like planting seeds, putting money into assets with potential to grow over time. You invest in stocks, bonds, real estate, or funds, all designed to increase in value long term. Just as seeds become trees, your money can grow and multiply with the right environment and time. Here's where it gets interesting. Savings aren't as safe as people think due to inflation. Inflation is the gradual rise in prices, meaning your money buys less over time. Think back 10 years, a cup of coffee or a bus ticket cost less than today. That's inflation in action. The same dollar buys less, eroding your purchasing power. Imagine $1,000 in a savings account earning 1% interest annually. After 10 years, you'd have about $1,100, which sounds okay. But if inflation averaged 3% annually, your money's real value would shrink considerably. What cost $1,000 might now cost $1,340, meaning you've lost purchasing power. Your money stayed safe in numbers, but weaker in value, unable to buy as much. Think of it, keeping money in savings is like filling a bucket with tiny holes. The bucket looks full, but slowly, drop by drop, you're losing what's inside. That's inflation eating away at your money. This is why investing matters. It allows your money to grow faster than inflation to move forward. Let's look at a real-world example to illustrate this powerful concept. If you saved $1,000 in 2000 at 1% interest, today you'd have around $1,220. But investing that same $1,000 in the S&P 500 would yield over $4,500 today. That's the undeniable power of investing, showing how your money can truly work for you. So why don't most people invest? The answer lies in human psychology. Savings feel safe. Seeing the same number in your bank account daily is comforting. Investing, however, feels uncertain. Prices fluctuate and values can drop. We often fear loss more than we enjoy gain, leading to hesitation. But here's the key. In the long run, investing almost always outperforms saving. Short-term ups and downs are like airplane turbulence, scary, but the plane still moves forward. Another important point, investing is not gambling. Gambling relies on chance. Investing is owning real assets, pieces of companies, government bonds, or funds representing economies. These assets create value, pay dividends, and grow with the economy, building wealth. Let's return to our principle. Investing is not magic. It's a powerful tool. A hammer is a tool. It can build or sit unused. Investing is the same. You don't need to be wealthy, an expert, or predict the future to start. What you need is to understand its importance and why waiting is the most expensive mistake. Delaying investing by just 10 years can massively impact your financial outcome. Imagine Alex, who starts investing $100 monthly at age 20. Mia waits until age 30 to do the same, starting her $100 monthly investment a decade later. By 60, Alex has around $380,000, while Mia has just $180,000. Even with the same monthly investment, time was the only difference, highlighting compound interest's power. That's why experts advise, start early, even with small amounts. Investing $10 a week today beats $100 a week 10 years from now due to compounding. So, Savings protect your money, but investments actively grow it. Inflation slowly takes value, but investing fights back, preserving and increasing wealth. Money working for you is more powerful than money sleeping in a bank account, passively losing value. Investing matters because it puts your financial future in motion, creating long-term prosperity. You can start with as little as $10. The key is not to wait, but to begin your investment journey today.
Now that we've explored the principle of making money work for you, let's bring it down to earth. How do you actually get started? The good news is that you don't need to be wealthy, and you don't need thousands of dollars to begin investing.
In fact, today, many platforms allow you to start with as little as $10. The most important thing is not the size of your first investment, it's simply the decision to begin.
Let's walk through a few simple examples. The first option is the deposit account or a certificate of deposit, also known as a CD. These are the most basic forms of investing. They are low risk, and while the returns are relatively small, they provide a safe way to build the habit of putting money aside and watching it grow. Think of them as training wheels for investing. You don't go very fast, but you learn balance, patience, and consistency. Next, let's talk about stocks. When you buy a stock, you're buying a share of a company. If that company grows, expands, or becomes more profitable, the value of your share grows as well. Stocks are powerful because, historically, they've provided strong long-term growth. But they can also be volatile. Their price can rise and fall in the short term. That's why stocks are best suited for long-term investing, not short-term gambling. Remember, when you own stock, you're not just holding a number on a screen, you're owning a piece of a real business. Another great option for beginners is ETFs or exchange-traded funds. Think of ETFs as a basket filled with many different investments, stocks, bonds, or both. Instead of choosing one single company to invest in, you get a slice of dozens, even hundreds of them. One of the most famous ETFs is the S&P 500 Index Fund, which tracks the 500 largest companies in the US.
This means if you buy just one share of an S&P 500 ETF, you're instantly investing in companies like Apple, Microsoft, Amazon, and hundreds of others all at once.
This spreads out your risk and makes investing much simpler, especially for beginners.
Here's a metaphor to keep in mind. Savings are like standing still, while investing is like walking forward. Standing still feels safe, but you never really move. Walking forward, investing, sometimes means the road is rough, with bumps and dips along the way. But as long as you keep moving, you end up much farther ahead than if you stayed in the same place. Let's break down a practical scenario. Suppose you invest just $50 a month into an S&P 500 index fund. At first, it feels small. After 1 year, you've put in $600 and maybe it's grown to $640 or $650. That doesn't seem life-changing. But fast forward 20 years. With consistent contributions and an average return of 7%, your $50 per month becomes over $25,000. That's the power of steady investing. Now, if you increase that to $200 per month, the total after 20 years could be over $100,000.
This isn't magic. It's simply math, discipline, and time working together.
Another important thing to understand, investing doesn't have to mean picking individual stocks and hoping for the best. In fact, for most beginners, the safest and smartest way to start is through diversified funds like ETFs. Why? Because even if one company struggles, dozens of others can balance it out. It's like having a basket of fruit. If one apple goes bad, you still have oranges, bananas, and grapes to keep things fresh. And what about risk? Every investment carries some level of risk. But the biggest risk of all is not starting. If you keep your money only in savings, inflation slowly eats away at its value. Over 10, 20, or 30 years, that loss of purchasing power becomes massive. By investing, you give your money a fighting chance to grow faster than inflation and build wealth for your future.
Now, here's the bottom line. Investing is not about luck, and it's not about being rich. It's about using tools that are available to everyone. Today, apps and online platforms make it easier than ever. With just a smartphone and a few clicks, You can open an account, deposit a few dollars, and begin your journey.
The key ingredients are consistency, patience, and the courage to start. So let me leave you with one powerful line to remember. Investing is not magic. It's simply a tool, and it's available to everyone. The earlier you begin, the more your money can work for you. Think about this. If you can find $10 today, you can start planting the seeds of your financial future. $10 may not feel like much, but over time, with consistency and compounding, it can grow into something life-changing. So, don't wait until you feel ready or rich. Start with what you have right now. Your future self will thank you.